Southeast Radio's Business Matters with Karl Fitzpatrick.
Well, in recent weeks, the announcement of worldwide tariffs by the US plunged the markets into chaos. So how should investors react during periods of market uncertainty? My next guest, Karl Rogers, the Chief Investment Officer with Elkstone, believes that they need to remain rational, and he joins us now to tell us how this can be achieved. But first, Karl, I'd like to get an insight into your own career and your role as Chief Investment Officer with Elkstone.
Good morning, Karl. Thanks for having me. Yeah, absolutely. So I took a very non-traditional career path from being born and bred in Dublin. So I started on the trading floors here in Dublin, trading commodity markets before moving over to the States, where I worked within quite a niche commodity market. I traded the price of electricity across the US wholesale grid. I did that in Boston and Canada for a few years before moving over to New York in the hedge fund industry, where I was a hedge fund manager with the multi-strategy fund in Manhattan, but also ran a fund of hedge funds. From there, I moved back to Ireland, where I ended up joining Elkstone as the Chief Investment Officer, while also joining Trinity College Dublin as an adjunct professor within the Masters of Finance program.
And provide us with an insight into Elkstone.
Yeah, so Elkstone is a homegrown entity, so we have both an Irish focus and a global focus. The Irish focus is direct investments into both venture capital, early stage Irish startups, as well as Irish real estate focused on the residential sector, so purpose-built student accommodation and apartments and townhouses, while the global investment side of the house is your more so traditional wealth management, building global multi-asset portfolios across both public markets and private markets.
Prior to geopolitical events and economic turbulence recently, how would you have described the performance of the markets?
So prior would have been very much in line with, the past kind of 10 to 15 years. So we were in an environment that was very much conducive to growth and high asset values, being primarily driven by the low interest rate environment, the very loose central bank monetary policy, and the fair share of optimism and positive outlook among the market participants. Of course, that started to change in 2022 with higher interest rates, higher inflation, and a few more risks developing. However, the price action hadn't significantly changed until earlier this year, as you mentioned.
And of course, in recent weeks, we have heard how the announcement of worldwide tariffs by President Trump plunged the markets into chaos. Were you surprised by the extent to which the markets reacted to that news at the time?
Yeah, so it happened over a number of weeks. So the first initial drop during March was one where U.S. equities dropped in or around 10%. But the behavior of the markets was a little different than what we normally expect a 10% drop to look like. And that's really because it was somewhat expected. So we didn't see a spike in volatility. We saw a rotation out of the US and into Europe, where European equities were doing quite well. So a traditional rotational play. But essentially what we saw was there was a known risk that was occurring with President Trump coming into office, and it was starting to play out, and it was expected. But that significantly changed on April 2nd for the wider tariff announcement, and that did cause a little bit of fear and panic and an unexpected nature. And then from that point, we started seeing a much more traditional type of price action or market behavior in terms of more fear and panic, a spike in volatility, and kind of significant drops across the global equity markets as opposed to a rotation.
In the midst of chaos, how does collective psychology drive the markets?
So investor psychology is likely the primary driver of prices. You have both fundamentals and you have sentiment. And Mark Twain is accredited for a quote he used. Says, history doesn't repeat itself, but often rhymes. What he means by that is the events that occur within the markets tend to change, whether it's the global financial crisis, COVID, or what we're witnessing now. But the rhyming component is markets are still driven by market participants, and there's an investor psychology attached. And that psychology is what tends to drive the upper and lower elements across a market cycle, as well as, the short-term panic and fear that we're seeing right now that leads to significant underperformance, usually versus the general markets. I'm happy to touch on that.
And it looks like President Trump is starting to roll back on playing hardball with China. What impact do you think that will have on the US markets?
So what we're seeing is a relief in US markets. the news, the announcement of the tariffs in the first place on April 2nd was really just the first move to a greater plan. What we're seeing is a little bit of a rollback there, likely given the market reactions, especially within interest rates. And as President Trump will be particularly sensitive to interest rates increasing given the size of the U.S. burden and the amount of refinancing that's needed. So it's not a huge surprise that he's coming back, but there's still a lot of uncertainty out there. And for people making price predictions, it's the equivalent of shooting in the dark, just given the level of uncertainty right now. And macro forecasting is something that is very, very difficult. You need to be correct in your prediction, but your prediction also needs to have value as well. So, living in more uncertain times right now.
And of course, we are in the midst of a 90-day pause on a lot of these tariffs facing a lot of countries, and we're expecting announcements over the coming weeks and months by President Trump in relation to claiming some wins over countries in terms of deals that he's going to do with them. Do you think that that's going to have any major impact on the market?
So it will, and it goes back to that idea of the uncertainty and that uncertainty level, primarily in the path forward, how long it's going to take, how it's going to develop, how areas are going to retaliate, and then what the U.S. will do in turn. So that increase in uncertainty and the timeline associated is significant, as much for investor psychology as it is for the actual fundamentals. But of course, when you're looking at the fundamental side, the fundamentals is going to come through, whether it's today, whether it's 90 days time, or as the market cycle develops, likely at an increase of cost to companies, disruption in supply chains. And again, it's about how this book unfolds one chapter at a time.
And at a more macro level in the US, what is the likelihood today, in your opinion, of a recession and indeed increases in interest rates over the next 6 to 12 months?
So it goes back to the earlier comment about macro forecasting. One of our core investment philosophies is that we don't do it. We don't believe anybody has an edge in macro forecasting. But at a high level, I wrote a memo out to clients soon after the initial Trump announcements where we saw interest rates come down. We saw interest rates come down in markets because market participants expected an increased probability of a recession. The central banks, however, unlike from the 09 to 21 period, have to deal with higher inflation, and tariffs have a direct impact on increasing costs and driving higher inflation as well. So central banks are not in a position today, as they would have been 3 years ago or in the previous cycle, where it's easy for them to drop interest rates. I think their primary focus is going to be on inflation and battling inflation, and we're starting to see that play out in the markets where we've seen quite the U-turn from the initial drop in yields to a sharp increase in yields.
So, Karl, with all of that in mind, is it more important for investors to be looking to understand the prevailing market psychology rather than seeking explanations for the moves in the market?
Absolutely. I think that's one of the key elements of, what Howard Marks would call superior investing. By that, I mean what investment professionals are trying to do is get greater than average market performance. So market psychology and what the consensus of market participants does is leads you to average performance. In order to outperform or drive higher returns, one needs to do something a little bit different than what the general market is doing. So not following the herd and being slightly more contrarian in nature, essentially taking the information that's coming in, digesting it differently, and making independent idiosyncratic decisions. So certainly not just following the news, following the narratives, as that will by definition provide you those average returns. Most people should be taking in market psychology and the optimism or fear or greed levels that one is seeing, and adjust how aggressive or defensive one is being in the portfolio. And right now we're in a brand new environment than we were 3 years ago. So move forward with caution, given the uncertainty levels, is certainly the call here.
So rather than investing on political outcomes, how can investors adopt a more resilient approach to investing?
Investors will hear the term absolute return. Most believe that's a strategy, but I call it's an outcome to a strategy. If one is trying to invest and get robust returns across a full market cycle, one needs to expand the investment universe to increase the toolkit available. So more different strategies, more different markets to be able to add return streams that are robust and perform well across all the components of a market cycle and not just one or two that do particularly well. And we're starting to see that across the investor universe, where investors are starting to move beyond the traditional 60-40, which is 60% in public equity markets and 40% in bond markets. And investors are realizing that we can't expect what used to drive the returns of our portfolio in different conditions to be the same primary drivers of a portfolio as we're in very, very alternative conditions: high interest rates, high inflation versus low interest rates and low inflation. So we're seeing that in, for example, the pickup in gold that recently hit a new all-time high of $3,500 per ounce. We're seeing investors start to move into more different types of markets and strategies in order to add a bit more defensive element and robustness to their overall portfolio as we navigate through full market cycles.
So when events like this occur, in terms of what we're seeing in the US, you advise investors to remain rational, but how can they ensure that their panic does not cloud their judgment?
This is one of the biggest challenges when it comes down to managing money. Retail investors very often underperform the general markets, and a lot of that is driven by investment decisions that are behaviorally driven during times of market stress. So we would have seen in the likes of April 2nd, April 3rd, during those initial sell-offs, investors go and panic and sell. What that means is they are then out of the markets and tend to miss subsequent recoveries, and that can be detrimental to the overall investment performance over a full market cycle. And there was a good example there where, the S&P 500 moved up 10% in a single day. If investors panic sold during the initial sell-off, they would have missed that 10% recovery. When you look at a bit more of a study over 20 trading years, which is over 5,000 different days within the S&P 500, the average return was about 10.2%. But if you missed out on the largest 10 individual days, so only 10 out of 5,000, the annualized return moved from 10.2 down to 6.8. So it's all about time in the markets versus timing the markets. And we need to be aware of these behavioral biases and behavioral-driven tendencies when it comes to the investment portfolio and try to mitigate them as much as possible.
So, Karl, in your opinion, are we likely to see the same market reaction if proposed tariffs are imposed after the 90-day pause?
By that, should we expect a full reversal? Likely not a full reversal. And the reason for that being is other areas, market participants and countries will now be aware of what could come and the uncertainty levels and the volatility that can come into the market under President Trump during his tenure. So it would be unlikely that we would see a full reversal because there would be more caution out there, but there would be a significant U-turn when it comes down to the prices. It's also dependent on how long it takes for a U-turn to occur, because over time, the effects of these tariffs can trickle down to the real economy and have a real impact, which would be difficult to unwind.
And more generally, what is appealing to investors right now?
So I think there are two overriding themes. One is across public markets, increasing the different number of markets and strategies, the likes of gold, the likes of commodities, the likes of CTAs. And the other one is a significant inflow into private market investing, which has become a lot more accessible over the last 18 to 24 months. So we've seen a lot more interest in the likes of private equity, private credit, infrastructure, and real estate that's starting to get opened up to what's called the private wealth channel.
Do you see any emerging trends that investors should be watching over the coming weeks and months? So
when it comes down to investing, the timeline for investing is your 5 years, your 10 years. Shorter than that, it would tend to be called trading. So when we look at trends, we're looking at these long-term tailwinds, and these mega trends that persist would generally be, digitalization, decarbonization, and deglobalization as well. And we're seeing the latter play out in April. Digitalization, you would have seen the theme around AI and operational efficiency, and decarbonization, which is, of course, the move to green and net zero carbon emissions. And we're starting to see much more of a move towards more renewable energy and so on. So I think those mega themes will continue to play out, and we're seeing a lot of thematic investments across both public markets and private markets trying to take advantage of the tailwinds that are present there.
What would you say to those listening this morning that are approaching retirement age and have a lot of their pension in the stock market?
So, the rule of thumb is, of course, to start spreading it out and moving more and more into credit and bonds and fixed income, which are in the lower end of the risk spectrum. And the credit markets right now, unlike 3 years ago, are actually looking very attractive from both a relative perspective, but also an absolute return perspective as well. And that's due to the increase in interest rates that we've witnessed from 2022. So having a larger allocation on the credit side is certainly desirable from both a relative and relative to equities, as well as an absolute perspective in terms of the absolute yield that one is able to get from credit and being higher in the capital stack, meaning lower risk than the equity component.
And I know that Warren Buffett recommends the book The Intelligent Investor for anyone that wants to know more about the world of investing. Are there any other book recommendations you can provide?
As opposed to a single book, what I do recommend is to listen to Howard Marks' memos. Howard Marks is the founder and chairman of Oaktree Capital Management, which is a bonded credit manager, both in the public and private space. He's been writing his memos over the last 30 years that are available on their website and provide incredible insight into his way of thinking.
Well, if you've just tuned in, that was Karl Rogers, the Chief Investment Officer with Elkstone. And I'd like to thank Karl for sharing some valuable insights with us this morning.
Southeast Radio's Business Matters with Karl Fitzpatrick.